A number of prominent figures and large institutions in the world of finance have just come out with some very concerning warnings around the current state of the US economy and the scary direction that things could be heading in. The CEO of JP Morgan, Jamie Dimon, is one of those who has raised a number of red flags about the economy in the last week or so, the first of which is him urging the US to reduce its national deficit, warning that it will become far more uncomfortable if financial markets force the government's hand. So far in fiscal year 2024, the federal government has spent $855 billion more than the amount it has collected in tax, according to the US Treasury Department. In fiscal year 2023, the deficit was $1.7 trillion, equivalent to about 6.3% of US GDP. In recent years, the deficit has been soaring amid tax cuts and massive stimulus programs meant to support the US economy during the pandemic. Dimon said, "Any country can borrow money and drive some growth, but that may not always lead to good growth. I think America should be quite aware that we have got to focus on our fiscal deficit issues a little bit more, and that is important for the world," he added. Now, when he was asked about the potential consequences that the US would face if it fails to drastically lower its deficit in the next few years, Dimon did warn, at one point it will cause a problem, and why should you wait? A problem, he said, will be caused by the market, and then you'll be forced to deal with it, and probably in a far more uncomfortable way than if you dealt with it to start with. And as we know, the government has pumped billions of dollars into the economy since 2020 in the form of stimulus checks for consumers, as well as grants, loans and bailouts for businesses to get them through the pandemic. And ultimately this money has stimulated economic growth, but has come at the cost of living costs and assets all rising in price, meaning that most people are no better off as a result of it. We know that inflation is far from under control just yet, still failing to fall below the 3% barrier, which remains much higher than the 2% central bank target. And one thing that is really shocking is that Jamie Dimon believes that inflation is actually a lot worse than people think, and that the market is too optimistic about a soft landing. He said, "Markets underestimate inflation's likely endurance as an array of factors keeps price upside churning. I think the underlying inflation may not go away the way that people expect it to. I think there are a lot of inflationary forces in front of us that may keep it a little bit higher than people expect." Now, Dimon believes that the transition to green energy, infrastructure build-out and geopolitical remilitarization are all sources of accelerating price growth. Dimon says that there is a lot of happy talk when it comes to inflation, and in his view, the chances that monetary policy stays unchanged or even tightens are higher than what most people expect. Dimon did say, "Stocks are very high, and I think the chance of inflation staying high or rates going up are higher than people think." And he adds, "My view is whatever the world is pricing in for a soft landing, I think it's probably half of that. I think the chances of something going wrong are higher than what people think." So Dimon clearly believes that this could cause a lot of problems in various areas of the economy, saying, if you have higher rates and, God forbid, stagflation, you will see stress in real estate and leveraged companies and private credit. Now, Ray Dalio has also been speaking out about the economy recently, and he has a wide range of concerns about the US, including its debt load and rising geopolitical risk that could deter foreign investors from buying US bonds. He says, "I am concerned about Treasury bonds because of the high debt levels which high interest rates are adding to." And he adds that, "I'm also concerned about the softening demand to meet supply, particularly from international buyers worried about the US debt picture and possible sanctions." Now, if investors become wary of the position that the US is in, they are going to demand a higher yield to make it worth the risk of them owning US Treasuries. And Dalio's warning comes during growing concern around the rising US debt pile, with the Congressional Budget Office forecasting that the US debt to GDP ratio will rise above the peak of 106% that was seen during the World War II era by the end of the decade, before continuing to rise onwards from there. Borrowing costs for the government have risen this year, with yields on 10-year treasuries jumping from 3.88% to 4.35% as investor expectations around interest rate cuts have been drastically scaled back. And with global investors losing faith and trust in the US, particularly around their huge debt burden and the soaring cost to maintain it, these yields could get pushed up even further thanks to a declining foreign investment demand. In fact, we've already seen weaker than expected demand at multiple bond auctions in recent months, and one of these auctions took place last month for $39 billion worth of 10-year treasuries, in which the auction saw the weakest participation from investors since November of 2022, forcing treasury dealers, who are mostly large US banks, to absorb far more of the debt auction than is usual. And in a similar case, last month also saw a $58 billion auction for 3-year notes suffer weaker demand than expected as well, with investors essentially only buying the notes if they got a better than market rate yield on them. China in particular has been selling a record sum of US treasuries recently in a move that clearly shows their intent to diversify away from US assets. Now, China did sell $53.3 billion in treasuries and agency bonds combined in Q1 of 2024 amid rising tensions between the two countries, the largest combined outflow in history. This is a continuation of a trend that has been taking place for the last 10 years or so, where we've seen China reduce their holdings of US treasuries from over $1.3 trillion in 2014 to now being below $800 billion. However, the pace at which they are dumping US treasuries has only sped up in recent years. Joe Biden recently unveiled a variety of tariff hikes on a range of Chinese imports like electric vehicles, while Donald Trump has also claimed that he could impose a levy of more than 60% on Chinese goods if he is elected. The chief Asia foreign exchange and rates strategist at Bloomberg Intelligence did say that China's selling of US securities could speed up as the US-China trade war resumes. And while China has been aggressively selling out of US debt, they have been buying up a lot of gold with this money, as their holdings of gold have risen in their official reserves to 4.9% in April, the highest in recent history. Now, China not only being out of the market for US debt, but now actively offloading this debt onto the market is a worrying sign for future US debt being issued, considering how thin the demand for treasuries is becoming. And the fact that China and other countries with close ties to China have been piling into gold does suggest that gold purchases by some central banks may have been driven by concerns about sanctions risk, said the first Deputy Managing Director of the IMF. We have even recently seen a breakdown in the relationship between gold prices and real interest on US treasuries, with both asset prices historically rising and falling together, but now the price of gold is far outpacing the price of US treasuries. And again, this just signals that there is a declining confidence and faith in the US economy and their fiscal situation, with gold now being seen as a far safer asset relative to bonds. Now, because of the US debt problem and potential impacts of further conflict, Ray Dalio does also warn that investors should look to move some of their money outside of the country. He said the risks the country faces are on the rise and make geographic diversification necessary. And perhaps the most concerning thing that Dalio did say is that he even thinks that there is a 35 to 40% chance of a US civil war breaking out, and that the probability has been growing in recent time, saying, "We are now on the brink." All of this has come at a time where the stock market is breaking new all-time highs. However, there are now numerous high-profile insiders who are selling stock, dumping their shares at the current prices, and running for the door. My previous video goes into more detail on this topic, and you can check it out by clicking on screen right now. Aside from that, if you enjoyed the video, please leave a like and subscribe, as that does help out the channel a lot, and thanks a lot for watching.